Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Monday morning edition of Benzinga's PreMarket Prep. Spencer Israel, Joel Elconin, Dennis Dick with you. Some interesting headlines this morning. We have another, second in 2 weeks, we have an acquisition of a company, a drug maker in the eye care space. So we'll talk about that. We'll talk about some big technical levels this morning, these prices that are like magnets here in stocks like Tesla and Visa and AXP and J&J. We have one real earnings company today, and that is Children's Place, and what a disaster that is. So we'll talk about PLCE as well. And our guest today will hold the GE talk until we're joined by John Inch at 8:35, senior analyst for Gordon Haskett. We know he's been all over the GE story for a couple of years now. Joel, what's the word here in the overnight session?
Well, we got to talk about yesterday's basketball game for a second.
No, we don't.
Okay, all right. Michigan needed that win.
I'm horribly depressed. I'm still depressed about it. It's very depressing.
All right, let's move on. Don't be depressed about the market. S&P futures, strong close on Friday. We followed through in the pre-market after our session. We got up to 28.1975, folks. I've been talking about 28.18. That was your December 3rd high. That will be our target on the upside. We gapped up over more trade optimism, so you will find support down at your close at 28.05. Even crude in the green by 46 cents at 56.26, major resistance in the upper 57 handle. Gold down for the sixth day in a row, down 12.40 at 12.8680. Silver getting close to that $15 level. That's down 9 cents at 15.17. Let's bring in Triple D here. And are you getting back that full trade move there?
Yeah, I'd say so. I feel like I'm back in the zone here a little bit. Takes you a day or two to get the screen time back in, get the feel back, but I feel like I'm ready to go. Here this morning, I've been up since 7, just kind of fiddling around. I've already made a few trades here this morning, wiggling out of some overnight stuff that I had and taking off some hedges. But I'll tell you, this market, it's relentless. And how often are we going to be able to rally on this potential trade deal?
I don't know. We'll have to bring in our
We're going to get a deal. We rally 100 points. We're going to get a deal. We rally another 100 points. We're going to get a deal. We rally another 100 points. I mean, we've rallied so much off of a potential deal here. I'm getting sick of it. And that's the headline again here, right? Spencer, Wall Street Journal now reporting we're going to get a deal.
Yeah. I would love to know. I really should go back and look how many days we've said, oh, we're, quote, in the final stages, quote, near a deal, quote, almost there, quote, on the last leg. To this morning, we're in the final stages, but I don't believe it until I see it.
Yeah, exactly. So I don't know. We've went so far now on a deal. You wonder if we are going to rally on the deal when it officially gets announced. But in any regard here, you cannot argue with the buy the dippers. They are out there. They are relentless. We know this bulls are fully back in control here. They have been for a while. We've been talking about the V bottom in the S&Ps, and doesn't look like it's going to give you another chance. Unfortunate for me, because like I said in my long-term portfolio, I did raise some cash. Was hoping to get the double test. It did not happen. But, you got to adjust and you got to find other ways and, get that money working there again sometime. But I tell you, man, this market is hot and it just continues to be hot.
Can I coin a new phrase?
Give it to me. Yeah.
No one at Wall Street has used yet.
Okay, well, because I'm sick of using BTFD.
Well, it's the, you know how they talk about the Fed put?
Yeah.
The China deal put.
Yeah, there you go. That's looming over the market here, that we know we're going to get a deal, and the shorts continue to get run over here, and the bulls continue to use that as food for running this market higher.
Yeah, I mean, it is. And the combination of the two long, because they've been trying to break the market the last couple of weeks, trying to stay away from, keep it under 2,800. The bulls came out in force on Friday, the weekly expiration. We are now 14 handles above that 2,800 level. So, knocking on the door, we're actually trading at the high of last week's range, which was 28.14. But we'll see what happens today. I mean, real good support, as I said, down at the close. And then you have some weekly numbers coming in at 2,800 as well. But right now, it doesn't seem like we're going to get down there. But do we want to do mergers? Do we
Sure.
Tesla?
It's not a huge deal, but it's a big deal if you own NITE.
Heck yeah.
Yeah, the news this morning for Nightstar Therapeutics, they are getting acquired by Biogen for $25.50 per share in cash. And I noted at the top of the show, that's the second such deal we've had in the past few weeks for a drug maker that makes companies that makes drugs for eye disease. We had Roche take out Spark Therapeutics, I think, a week or two ago now. And this is Nightstar is also in that same space. So we've now had two drug makers in the eye disease space get taken out in the span of 2 weeks.
Nobody saw this one coming. This did not have a run up. This really has had nothing. It's just kind of been hanging out, and boom, 67% windfall here for anybody who obviously owns the shares. $25.34, not much of a discount from the $25.50 takeout price, but on these small deals, nothing usually stops them. So not surprising that the risk arbs are pricing in only, it looks like a 0.5% discount there. So $25.50, not much to really say about NITE, and Biogen, such a small deal for them. I don't know if it's going to move much either. But what about, like, is there other stocks that could potentially, like you made a good point here, you had a couple stocks similar, in a similar space here getting taken out. Is there anybody else who could be potentially a target?
I don't know. I mean, there are a bunch of names, but no one's.
I don't follow space
really
at all,
trading.
so.
Neither do I.
No one's really trading. I see names like Ocular Therapeutics, OCUL, which in theory they're in the space, but I didn't see any trades on them this morning. What about names like? No, these are really small. These are like micro cap names. So I would go. I don't know.
Hard to find them.
Yeah, it's tough to find names that are also in this. Ticker I, National Vision, EYE. I don't know.
I was thinking about that one just because of the symbol. Barron's is adding a little bit to not for eye therapy, but why Big Pharma is diving into gene therapy. That was your cover story on Barron's this weekend, and mentioned Big Pharma going after some of these smaller firms. I see CRISPR Therapeutics is trading up, as well as Editas Medicine. So
this is off Barron's though.
Yeah, that's off Barron's.
So okay, CRSP. What else? Because Barron's moves stocks. So what? We haven't done a Barron's rundown on a Monday for a while here. Well, what? So CRSP. Which other ones?
EDIT Edit.
Yeah.
And
that's trading up 50 cents.
Yep. And they talked is the potential acquirers, which is not as interesting, Pfizer, Novartis, and Sarepta that have already bought their way into the field. So the only thing about this is some of these therapies are really expensive, very, very expensive per dosage. So they're paying up for them. I mean, is the government, is insurance? I mean, these are some very, very, very expensive therapies. So I don't know. The big pharma's diving into it. They must not be worried about it. But, Barron's moving a few stocks today. The CRSP, I know that's a pretty good mover. Up $1.32, Edit up 86 cents.
I mean, really, when you look at it, and obviously everything has come back from the December lows, but biotech has performed very well too, especially smaller biotech. Because check out the XBI, bottomed back on December 24th when everything bottomed at 64.38. We're 91.81. So you're talking about a 25-point rally on $66. That's over 40% that the XBI is up here in about 2 months.
Yeah, very nice move. Still off. Yeah, very, very. I mean, the mergers, they could have to look at break down the components in that, but definitely, the mergers are helping, and the big companies are moving too. Biogen, this is not a huge deal for them, so I don't expect them to get tarred and feathered off this.
So and Biogen's come back too. I still own Biogen in my long-term portfolio, but it's come back. But it's running that wall again, 340. It seems like you go back here, and it's funny how these magnet levels work, but it's crossed through 340 multiple times. It's traded above it for a while in mid-2018, then it went below it, and then it bumped up against it a couple times, tried to take it out. It's really struggled at 340, so I'd expect that same area to continue to struggle. But, if you bump your head up against the ceiling for long enough, eventually you do take it out. But speaking of magnet levels and the stock, we talk about all the time is Tesla. And I mean, this 300 level, like really when you put it in perspective, it's gone nowhere in the last couple of years. But man, if you've been playing like the magnet trade off 300, saying it gets up to 320, well, I'm going to go short because it's probably going to come back to 300. Gets down to 280, I'm going to go long because it's probably going to come back to 300. I mean, there's been so much over the last 2 years, so many crossovers over 300 that sometimes a stock can go nowhere, but if you identify a stock that's going nowhere, and from a put writing perspective or call writing perspective, that works as well, you can make some money with these stocks still. So 300 has just been a magnet level for Tesla. Can't seem to get away from it.
No, and had a nice 3-day run on the news, and then bad day on Friday, but I believe he tweeted something today about a new model coming out, I think, Spencer. What's that, in March? So back up, trying to get back over that 300 magnet. But if you have the stomach to trade the trading range in this one, that's what you've had for the last couple of years.
Yeah, March 14th, they're going to be unveiling the Model Y. So I guess we'll wait and see what that is on the 14th.
Let's move over to the big story of the day, and that's going to be Children's Place, which pre-announced here. And they were scheduled to report, what, tomorrow, Spencer?
I believe so, because I think their call is tomorrow, the conference call.
Well, they had to pre-announce here a day before. So anyway, it's just for anybody who had decided to maybe hold it overnight ahead of it. I'm lucky I didn't have that one because we know a lot of times I do play these things long ahead of the earnings reports. Glad I wasn't in this one because, it's an awful day for shareholders here this morning.
Yeah, they halted it just before 7 a.m. And then about 5 minutes later, the report came out, and it was a doozy. Q4 EPS, $1.10 versus a $2.12 estimate. Sales.
That's a miss.
A little bit of a miss. Sales of 530 versus 554 million. So a miss on the sales as well. The guidance was way off. The fiscal year EPS guidance that they gave, they basically guided in the mid $5 range, and the guidance was just below $9. Their sales guidance was around a $1.9 billion versus a $2 billion estimate. So the slight sales miss, huge EPS miss for the fiscal year and for the quarter. I don't know what this is. The Q1 EPS guidance, they guided that they were going to lose money versus a $1.61 estimate. Is that right? Holy cow.
This is a disaster. Yeah, I see it. Supposed to lose 40 to 70 cents, and estimates are up at $1.61. What are they citing here? Did they say a reason behind this? Like children aren't wearing clothes anymore? What's going on here?
I haven't looked super closely, but when in doubt, blame the millennials. I don't know.
They're doing 40 to 45 store closings. I mean, this was a company I didn't think that had problems, and all of a sudden you look at this, you're like, oh man, they got problems.
Joel,
sales were down?
Joel, who was it? Was it Rachel Shasha? Who was it on our
show? Yeah, okay. You're right.
Yeah.
Hat tip to her.
Yeah,
she's been embarrassed this one for a while.
Oh yeah.
Yeah.
Well, good job, Rachel. If you're listening, great job. Bring Rachel back on, man. We got to get some more calls from her. It's a big call.
She's been sticking with this one. I know she took the heat on the way up. Now, 2-for-1 stock split here since it hit more than that.
$160.
Yeah.
And it hit 160 in October. I mean, you're talking, $160.23 in October. So here in what are we talking? 4 months. Halved. Yikes.
I guess the street was leading the right way on this one over the last couple months. Not much to see. Pre-market low 76 and 76.26. We're $3 away from that. So there's your support level. Basis the monthlies here. You got to go back to, you had a 71 low back in November of 2016. I don't know. I mean, the way these things move, the way Stamps moved off, its announcement, it's a possibility, but we'll see what happens. Big windfall for shorts here. Really, the only number I can give you is 76.25. That's your pre-market low, and your pre-market high has been 84.30. So those are the early levels there. in Children's Place.
I mean, we talk about buy the dippers and stocks here, but when you get a quarter like this, I can't bring myself to even think about buying a dip in something like this. I'm going to wait for this to stop going down because this feels like Kraft Heinz, obviously completely different, stock here, completely different company. But when they warn and announce this bad of news, sometimes it continues to leak for a few days. And KHC, if you were on the initial news, obviously dropped, but it continued to drop for another 4 days straight. So now you're looking at KHC and it gets a little love from Morgan Stanley, and maybe get the potential if you're looking to buy the dip, it'd be a better time now. But sometimes it's best to wait till they stop going down. Get a green candle at least here because it's some bad news. I don't think this is going to bounce right back. Not on this news.
No, I mean, when these stocks, you have people caught long-term and short-term holders of the stocks. The best you can hope for is for it to stop, go down, a couple of days of consolidation. Maybe the sellers get tired and you get a chance at a rebound.
So, and let's talk Kraft Heinz here just for a second. I know you've still got it, unfortunately, there. I got lucky to get out. We are getting an upgrade here this morning from Morgan Stanley. It's a valuation call here. I believe are they just going to neutral?
Yes.
They were at sell on this?
They're on neutral now. Equal weight.
So they were at sell on this. So good job, Morgan Stanley. They're up in it to neutral, and I did see it go by on my ticker saying it was a valuation call here. So that's the good news. The bad news is the stock is still in a lot of trouble. I mean, the reason I owned this once, and I was like looking, I even tweeted out, I was like, in the long, like I said, this after the news, I was like, long term, I think it's a steal in the 30s, but you just, I haven't pulled the trigger here yet. Simple reason is that dividend cut really looms large. And I still think if you're buying it at 33 and you're holding it for the next 5 years, you're probably going to make money because I think it's gotten to a point where it's cheap enough now, but they got some issues. So I don't even know if you need to strike right away here. So I just don't see it coming back to like $40, $45 in a hurry. That dividend cut really hurts when you get news like that.
There's still pending investigation and
a lot of issues here still.
Yeah, a lot of things. Need a vote of confidence. I mean, getting a vote of confidence here, that's a big move here for the stock. And decent volume, too. 150,000 in the pre-market is a good volume for KHC, trading up 70 cents.
You could get a lift. I mean, short term, you could get a lift here. You got an analyst defending it. That's what it needed. So it's got somebody coming up finally defending it. So if you are going long here, I'd lean on the low, 31.82, the low of the move. It starts taking out the lows. I always say stocks making new lows, you got to go. So if you're looking at it here, maybe get a little pullback, maybe it sneaks its way back into 32s today, lean on it for a point. I can't argue with that trade. I don't know if I'm going to take it just because I think there's still a lot of problems here, but short term, I could try it.
Just hanging out. You got a pesky seller here just above $33, been trading between 33 even and 33.15. Really since your 4 o'clock open. My area interest is just above that. Let's call it 33.50. Friday's high, 33.49 and 33.64. So if you get a little pump up to that area and then it starts to roll over, just be cognizant that that's a decent resistance area. That's a big move, 2%. Off an upgrade, up 70 cents in Kraft Heinz. Take a lot of stock, move that during the day, but 33.50, that'd be a good number in it. Moving forward in today's session, still 40 cents away.
Let's stick with the ratings just for a few minutes here because there's some more interesting ones as well. Let's go. We're talking retailers. We were at least with Children's Place. Let's go to Dillards. It's getting downgraded to underweight, which is the equivalent of sell at JP Morgan here this morning. Stock that lifted big time there when I was away, and I'm assuming that was earnings. What was the lift?
Yeah, I don't think we.
I was away. I was down in the Dominican Republic, sitting by the pool, drinking a cocktail, and watching my 1-year and 4-year-old kids run around and splash around. So I have no idea exactly what the Dillards gap was. So fill me in. Was that earnings?
Yeah, it was earnings on the 25th.
Okay, so you got the earnings gap up. It held for a couple of days and then starts leaking significantly here. I'm not sure the catalyst there. Was there a retailer that I'm having, a Monday morning goldfish memory here? Was there a retailer that knocked down all these on Friday? Like I know Nordstrom reported. I guess Nordstrom went red. Was there a reason Dillards though turned around and gave back $5?
No. I mean they don't. they just sell clothes and stuff, right? They don't do any.
Yeah. I always pair them up, and I pair trade these things, and I always put Macy's, Nordstrom, Dillards, kind of all together. Was there somebody, a retail, that really got hit hard? That, like, if you look, we know Nordstrom's a big one. Macy's, Kohl's, and Nordstrom all seem to always go together, but Kohl's held on. Macy's really didn't go down much. I mean, a little bit there. Nordstrom was up at 50 pre-market on their earnings report and gave it all back. Why Dillards, though, goes all of a sudden boom and gives back $5? That's a significant move.
It's a thinner stock. I mean, the Amazon news intraday was more grocery related, so I don't think.
No, definitely not that.
That's not that.
This isn't good now. Now it's in the gap.
Yeah. The only thing I can give you, the only relevant level on this one would be 68.56, and that would fill the gap from the earnings. And coming back on the upside, you get anywhere near $75. I think that'd be, it's only $2 away from, or $1.40 away from there. 75.11 was Friday's low, and you also had a low at 75. Yeah, now it's going to turn. So there's your support and resistance. Careful, this one, it's fallen into a gap. Let's see if it can shrug it off and it would go green on the day. That would be one thing. This is a thinner stock.
I don't think so.
No, I don't think
so this is going to continue to leak. And when you get a downgrade to SAL equivalent, JP Morgan, people take note. There's people who are underwater Friday. Anybody, any day trader, and you see a lot of, even programs that, do mean reversion, and then something's falling 3 straight dollars like it did in the last hour. You'll see, traders that are significantly underwater on that. Even market makers, if they're trying to make a market, it's hard to wiggle out when the thing's going straight down. So anybody who held that overnight, hoping that maybe it'll pop back to 76, 76 and a half, I get my money back, are going to be very disappointed here this morning. So now they are going to line up at 75. I think the path of least resistance is probably even lower for Dillards here. This is not looking good. It could have filled the gap. Not today. It's too far. But, I mean, this thing could eventually fill the gap. So I want no part of this at 73.60.
What was that DDT? Is that still around? That's
the preferred on Dillards. And I actually was in that. It actually gapped down on the end of the month. Was the end of the month Thursday? I'm trying to remember the end of the month. I think it was Thursday, wasn't it?
Yes, it was.
Gap down. I actually bought a whole bunch there near the close. Well, I tried to buy a whole bunch. I actually was at 35.61 and all the way down. I got a little piece. But the specialist decided to penny my bids. And what I mean by that is he traded it on the closing print. It was due to gap down, and he put the whole print 1 penny above where my big order was. So, that's the one thing when you put bigger orders out there, sometimes you get pennied because they'll look at that and say, no, you're not getting it. I know this thing's going to pop back. So I ended up getting a little piece early, but I didn't get the closing print, which would have been really nice. I think bounced back 30 cents. But you're talking on DDT, you're talking about a stock that moves 10, 20, 30 cents, the preferred stock. So it's got a nice dividend. I've had this one on my long-term portfolio for a long time. It's still got a 7.2% dividend. I still like it in the 25s. I mean, I don't think Dillards has credit problems here. It's paying you 7.2% here. It is callable, and what that means is that they can call us in at any time. Like it's already callable right now, but they haven't called. It's been callable for years. Wow. They haven't called in, so they don't mind paying the 7.5% coupon, I guess, which is maybe a little bit of a red flag in itself, but it's been paying for a long time. I had the portfolio for years. It was paying me for a long time. I don't have it anymore. It's had some rallies, but every time it gets in the lower 25s, it seems to be a buy. That's DDT, the preferred.
Right. Yeah, I'm seeing it trading here. That big red candle. It did rebound.
That was a big. On that end of the month, there was a lot of preferred stocks that had big sell imbalances. And I bought a bunch too on the close there, and different ones, because sometimes these things usually they'll bounce right back on the preferreds, and you just have maybe some institution or a couple institutions that are jockeying, doing some adjustments for the end of the month, maybe raising some cash, doing some whatever they're doing. I don't know why the reasons they're doing it, but when you get a preferred stock gap and down 1% on the close, it's usually a pretty good buy that it's probably going to pop back, especially when you have interest rates stable. If interest rates aren't stable, that's when preferreds can really move around. But preferreds trade off interest rates, and interest rates have been somewhat stable, at least lately. I know the TLT has been hit a little bit there the last couple of days, but for the most part, when I'm talking stability, I'm talking about like when you're getting to credit concerns and stuff, and you're getting into, there are concerns that, something bigger is happening, like end of November or end of December, we had a lot of preferreds getting hit because they were hitting everything. And people were worried that, even I was worried that, maybe this is going to turn into something bigger. obviously didn't, and they've come back. So it seems like on the dips, the preferreds are buys now too.
And they're just a little bit longer term perspective on that one. I mean, when you right, Dennis, I mean,
well, I day trade them though. I don't trade them much. Only when there's something hitting my filters that there's a significant move. I'm not jumping in something for a nickel preferred and wasting my time. But when you see a preferreds and they're gapping down 0.75% or 1%, if I can make 0.5% on that, that's a pretty dang good day trade right there. So when there's big movement on certain days, and typically preferreds, I'm only going to trade them usually end of the month because they might get some moves. End of the quarter, they often get moves. They're usually pretty good end of the quarter. And third Friday of the month. Other than that, I'm usually not looking at them. But I've always got scanners. I have scanners that just run preferreds. And if something's happening, it'll pop up and say, hey, check this out. We look like we got some sellers, or we look like we got some buyers, or we got at least some action over here. Then I might, go over there and start day trading it. But typically, they're hard to day trade because the spreads, aren't super. Some of them are fairly wide even for some of these things, and you just can't get in and out. We know within the spreads. So I typically only day trade them when there's big action. Yeah,
there was big volume on that Thursday. I mean, do you just want to go into? We're getting a question out of the YouTube chat about what does preferred actually mean and what's the difference. I know we talk about them a lot. You want to give a 1 or 2 sentences?
Preferred stocks are just a hybrid, really, between equities and bonds. So they trade more, and it's just the coupon. You're not participating in the actual, equity performance of the stock. So Dillards, what we were just using was DDS. They have one preferred out there, which is DDT. It's a capital trust, and which is a little bit different, but it still trades. It's basically a preferred stock.
It's a different share class. It's a different share class.
That's it.
Based on your capital structure, you can have different classes of shares that can do different things. Some might have voting rights, some might not. Some might, but you're higher on the food chain. Should there ever be a liquidation, you're higher on the food chain than
in the event of a liquidation, the preferreds get paid before the common. So it goes bonds. If you own the debt, you get paid first. Then the preferreds will get paid. Then the common gets paid. So you're higher on the food chain, but preferreds are basically just trade like bonds. So you're jumping at a preferred for the dividend for the most part. I mean, they do move around, and obviously even on bonds, it can move around. But usually when you're buying a preferred, you're buying it for the dividend. I own a bunch of preferreds. I mean, it's just a way of diversifying. On my long-term portfolio, I'm probably 10 to 15% preferred stocks. And it's just a nice way that gets you 6-7%. A lot of these do trade. Most of them in the 5s now because interest rates have come down so much. But you get the odd ones like DDT, and they're paying in the 7s still. It's nice to get 7% in a stable security. And typically, unless we're in a financial crisis, these are very stable. I know me and Joel, really kicked some butt buying preferreds back during the financial crisis. Those are some of my best long-term investments, where some of these preferreds were trading up to 35-40% yields.
Yeah.
And what I was doing back then, I was shorting the common against it. So I was hedging myself. So I can remember on HSBC, I bought a whole pile of the preferred that was trading $3 or $4 on the 25. So $4, it was trading at $4 on a par 25. And it was trading with a 42% dividend, still paying the dividend. And I was like, okay, well, in the event of liquidation, I'm going to be okay because I'm short the common against it. So I shorted the common, bought the preferred, and it really worked out well. The common went up, but the preferred went up way faster when we pulled out of the financial crisis. So I ended up making a lot of money on that. I mean, some of my biggest winners back during the financial crisis, my buddy Chris Banier, same thing. I mean, we were kicking some butt in the preferreds, doing arbitrage between the different classes because, you have some that were just opening way too low, some opening way too high. It was just nuts back then. That was 2008, 2009. So when there's trouble out there, preferreds are fun to trade. When they're not that fun to trade. But as long-term holdings in your portfolio, I like it from the diversification perspective.
The downside is they're way less liquid. You got to mention that, though. They're way less liquid than common stock.
They are somewhat. Some of them are fairly liquid, though. So they are somewhat less liquid. I wouldn't say way less. If you go into some of the Bank America or Wells Fargo preferreds, those are fairly liquid. Again, it's some like Dillards, he might pay a 0.5% spread, a 1% spread in a worst case scenario. So, and then if you get into some of the smaller ones, they're way less liquid. I mean, you get into some smaller stocks that preferreds, they could have really wide spreads. So I would stay away from those. But the bank preferreds are fairly liquid. And there's a lot of classes out there. And the reason they're liquid is because you can arb them against each other. I mean, some are going to be trading, they're all going to trade, within a certain extent. They track each other fairly well. So you get like 10 different Wells Fargo classes of preferred shares. They're all going to trade fairly closely together. It's all going to be a similar dividend. So, you can go like WFC.PRQ, WFC.PRT. There's a whole bunch of them. They're 5.8%, 5.75%. So if one gets hit, then the other one's probably going to be okay. But when there's crazy stuff going on, like even the night trading debacle back in 2012, they were hitting only certain preferreds, and I was like buying the ones they were hitting and selling short the ones they weren't hitting, and just basically doing the arbitrage against it. So that worked well, back then, because you were getting significant. Now you run into troubles because some of these are thinner and the locates, and it can be expensive for the borrow on some of them. So the arbs don't work as perfect as they used to. You can't be jumping those things for 10 cents. But when you can jump in those things for 40, 50 cents or a dollar, sometimes it pays pretty well.
Mr. Bobby 99 AAA, he just said, "Oh God, he just gave away my best tips on how to trade preferreds." That's how I've been making my living for the past 25 years.
No, there's a lot. I just gave it all away here in 5 minutes. Sorry. But you know what? There's going to be not that many people that are going to come in and be trading preferreds. They are fair. I used to trade preferreds a lot back 10 years ago, but they are trickier to get out on, and it's hard. I used to play market maker kind of, trying to make the spread on a lot of those things when they had the 1% spreads. You can't do that anymore, because we know the off-exchange market makers just match your quotes. There's a lot of quote matching tactics out there, and it's very difficult to capture the spread unless you're, an off-exchange market maker that buys retail order flow. So it's trickier to trade those things now. But when there's a liquidity, when there's movement there is some opportunities preferreds. We don't talk about preferreds much on this show, but there is definitely traders out there. It sounds like we got one in the YouTube chat that trade these things fairly actively, and they're obviously a lot less risk with those things. So you got to consider it's all risk return as well. So if you're only risking, 0.1, 0.2%, you can be making 0.3, 0.4% and doing pretty well.
Let's see here. What was that GE one?
There was a bunch of GE ones for a while. Most of those were capital trusts. Most of those, I don't know if somebody's on the board. And if you want to go, and if you want to get, there's some places to get some information. I used to always go to Quantum Online. It's a good place. You can just type in the ticker, and you can go GE, and then you go find all related securities for GE, and it'll spit out all the preferred stocks that are out there. Most of them are gone. They've redeemed almost all of them there. So I'm looking, I don't see anything left on GE. So there used to be a lot. It's like GK, GH, GB. I used to arb those things all against each other back in like 2007, 2008, 2009. We get some movement. And the one downside is the biggest reason why it's difficult to arb these things anymore is because the borrow rates or the locates can be difficult. So if you're not getting a borrow on it, or if you're going to have to pay up for it, you're jumping at something for a 0.5 arb, and you're going to pay 7, 8, 10% a year to do that. And if it takes you a week to get out of it, you're going to break even. So that's the difficult part, is the borrows got expensive. They weren't that expensive back in 2005, 2006, 2007, 2008. They were fairly cheap, but they're not anymore. On some of them, they still are. But that's the one thing you got to watch. If you're doing straight up arbitrage on preferred stocks, you got to watch those borrow costs.
We'll do one question and then imbalances. Dennis, what are you looking at in the market to determine if we are in a trending day versus a range day?
Oh, that's a good question.
You're more looking for inefficiencies, right?
Yeah, and that's the one thing too, is that I am an inefficiency trader. So that's how my style is. I like that preferred stuff. I like that stuff. Like I said, it only works well for me though on those certain days, because there's just not the liquidity that there used to be in the borrow costs. And Jimmy A bringing up some good points that sometimes they can actually buy you in if the locate goes bad, like we can't get a locate. But from looking where trendy days or it kind of just, it's difficult to say. Like, there's not just something that's going to dictate whether we're going to trend all day or not. Certain days are just more trendy than others, and it's usually after the first hour you can kind of see which way you're leaning. But we've had a lot of intraday trading is very difficult. When you trade, and this is why I do very little trading between 11 and 2. I've said that multiple times on the show. Middle of the day, I usually take off, do some other things, because it's difficult, because there's so much chop. And the chop is there, there's just, and especially on a day that isn't trending, it's, a lot of chop, and you're getting stopped out on everything. Especially if you're putting, stops and you're using stops out there. So it's tricky, really identify it ahead of time, whether we're going to be trending or not. But, just bring up your charts. And we've been in a trending market here right now for quite a while. We've been trending higher here for a better part of 2 months. We're trending straight down in December and straight up. And, so we have not been in really this market's been going nowhere. we've been slowly trending higher, and it's been the case to buy the dips in this market. So, from a longer term perspective, it's easier to identify. From an intraday perspective, not quite as easy.
Yeah, and I just to kind of make another comment on that. We're up like 9 3/4 handles now. The trend of the market's been up. I mean, we could go up and take out the pre-market high, come down and meander, and just end the same day where the market opened, right? But it's still a sizable gain for the market. It's still the trend, but a lot of the move took place overnight. So I just want to comment on that. Spencer, it's the time for our guest.
It is time for our guest. We're going to take a quick break and grab John G. Inch, Senior Analyst from Multi-Industrials at Gordon Haskett. So we'll be right back in a moment with Mr. Inch. Welcome back, everyone. Pre-Market Prep, Spencer Israel, Joel Elconin, Dennis Dick. Now we are joined by John Inch, Senior Analyst from Multi-Industrials at Gordon Haskett. John, how's it going this morning?
Good morning. I'm well. Thank you very much.
And we just wanted to get you on the show. We had the big move in General Electric last week, a stock you've been closely following, and we've been closely following your analysis here. Let's talk about the deal that they did with Danaher here and how that stock has really benefited from it. And I also just want to get your opinion, like when you need to sell. Like people know that GE needs to dispose of assets. Do you think they're at any, a little bit of a disadvantage here? Do you think, that's a factor? Because like the Danaher is continue to go straight up after this, and GE's gone down.
Yeah, no, there's no question. Forced sellers don't get the best prices. In fact, Danaher is selling this jewel in the crown. It's biopharma business, $3 billion of revenue, 40% EBITDA margins. That's 40. That's a big, profitable, important, fast growth business. They're selling it to Danaher for the same price that Danaher offered them a few months ago. So as it happens, what we think happened was Danaher approached them a few months ago, shortly after Larry took over, offered them 17 times. The company said, no, it's worth much more than that. And as we know, then GE released details that it was in confidential filings to IPO, the healthcare business. And then in the 11th hour, they went back to Danaher and took the exact same deal. Well, okay, it's interesting, right? The key competitors, Danaher itself was trading over 18 times. Agilent was trading over, I think 19 times. So to offer 17 times for this deal, it's not a bad deal, but it's clearly a sweetheart deal for Danaher. And it's very unusual when you do a deal of this size that the acquirer's stock price goes up as well. Normally the acquirer typically overpays because, it was competitive bid process or whatever. Well, it's clear to me that Larry, who worked, remember, at Danaher for many years as CEO, took this deal and it was probably not competitively bid, and it was the same price offered a few months ago. So, it's telling you that GE couldn't stand the heat of any sort of a risk of a healthcare IPO given market volatility of not going forward. And, we've called this healthcare sale, or now the biopharma sale, the last bullet, because it's really the only bullet they have left to restore confidence that liquidity is not an issue. So, look, I think liquidity is off the table, but you're still losing this business on a permanent basis. You're going to be left with a healthcare business that's relatively slower growing. It's going to be increasingly commoditized and has substantially lower profit margins. And as we learned out, if you sort of parse out the cash flow analysis, that business actually has a lot less cash than people think. So, look, I think that liquidity is not an issue for GE, but what this RemainCo is going to look like in 3-4 years is very much suspect, right? And there really is no room for a recession in any of this analysis, which is not exactly a conservative assumption. So, God forbid there's a recession in the next couple of years, we think GE is going to get squeezed very, very hard because it's still, even despite this sale of the biopharma business, has an awful lot of excess, debt and pension, both on balance sheet and then what's contingent or what could be coming down the pike.
Now, I did get into all the details of it, but isn't there any covenants in there that GE can perhaps reap a little bit more than like the initial amount that they received? Is there anything in there that, like, if perhaps that unit does better expected for Danaher, that GE can benefit, or have they kind of just washed their hands of the unit?
Seems like it's a pretty clean break. And remember, the deal doesn't close till the end of 19. So you're paying 17 times this year. But, if you look ahead, when the business presumably continues to grow and expand its profit, it's going to be even more of a sweetheart deal or a lower valuation on 2020, 2021 type of numbers. So, no, I think it's look, she's getting $20 billion roughly in the door after tax. They're applying a bunch of tax credits to use against the gains that they would otherwise have to pay against the business. You could argue that's a good use of the proceeds. It still doesn't take away from the issues at hand that GE in the next couple of years is going to have very difficult cash. Now, it maybe has better cash because they're retaining all of healthcare in 19. So the optics look better, but it doesn't matter. Aviation's got big cash headwinds. The renewables business has cash headwinds. They're eliminating factoring or downscaling it. That's cash headwinds. Trade payables are going down. They've got JV losses from the assumption of the Alstom pieces. It's a $300 million headwind. There's a lot more power restructuring coming. So what the company is going to do, remember, they're going to give an outlook meeting on the 14th of this month. They're going to give guidance for 19. It's going to be bad, but they're trying to tell everyone, hey, well, but look ahead 3 years from now, things are going to be a lot sunnier. But look, the markets don't look ahead 3 years for any company, let alone a company of this ilk that's had so much, internal issues that have been brought about. The market wants to give Larry Culp a lot of, benefit of the doubt. It just remains to be seen. The numbers are the numbers. If they can withstand a couple more years of very negative free cash, and what's the outcome at the end of the day? You have kind of a big crappy power business, a very strong aviation business that's at the peak of the cycle, and a wind business that's not going to matter, and potentially still a healthcare business with commoditized or increasingly commoditized diagnostic imaging at its core that may or may not be sold to appease creditors. So again, they just don't think that the stub at the end of the day is going to be worth that much.
We're on the line with John Inch. He's a senior analyst of multi-industrials at Gordon Haskett. How long have you been following GE?
About 20 years.
20 years. Oh, that's a long time. So when you see that
Thanks
price,
for reminding me.
When you see the price action that you saw up, I believe it was last Monday. I know you drilled down into the fundamentals and stuff. When you look at that price action and you see how, I don't know what percentage it was up on that news. Is it just, do you think it's just people there's I missed the boat buying GE at 666? Do you think it's high frequency traders just taking advantage of the move, or do you think it's people just in earnest saying, okay, I got to be in GE? when you see, I mean, it traded over 300 million that day. Do you pay any attention to to that individual price action during the day, or do you just stick to your fundamentals?
Well, sure we do, but obviously I'm not a day trader nor a desk trader, right? We're trying to make strategic calls and relative strategic calls. But what I'll tell you is that the market remains very much in a momentum dynamic where passive money, increasingly machines, kind of run the table. And so, the machines can't understand the strategy or implications. They just track what the other machines are doing and tend to follow along until they don't. GE is a bit of a special situation. It's an iconic name. It's owned still probably very heavily by retail. And I'm sure there's some of what you just said that everyone wants to catch, they don't want to miss the upside, if you will, or the perception of the upside. That said, below $10 or in this level still, I think it's very clear that the stock is trading sympathetically with credit markets. So raising $20 billion in that announcement immediately suggests that, hey, if you were worried at all about liquidity and credit, you really don't have to worry about that anymore. And, we haven't been worried about that for a while, but it's clear that the market has been worried about this. You can't look specifically at these very large percentage moves, in part because the stock was so low, it's been trading as if it were a distressed equity. And in many respects, fundamentally, it is a distressed equity after everything that's happened and how the cash has collapsed and the earnings have collapsed. Remember, in 2018, and that's with all of the businesses still in there, including rail and all the other things that they were selling, the company earned 65 adjusted cents. And the adjustment is including very aggressive accounting that the company invokes. And just prior to Larry Culp, they had repeated over and over that their guidance was $1 to $1.07. And the CFO was saying, well, maybe it's at the low end of that range. They earned 65 cents. Now we're getting rid of the best businesses in healthcare. We've sold the rail business, right? There's other little pieces. The power businesses that are being sold, the power business is under pressure still, possibly even more so. Remember, that's a business that it's got 2-year lead times. And they have double-digit declines in orders, core orders for the past 3 years. Well, that's not going to turn around. At the minimum, maybe in 2021, maybe. Even if markets are stabilized, you're not going to see improvement in that business for a very long time. So, I think that sometimes seeing the forest for the trees is important. I have no doubt that the stock will remain somewhat volatile, but I think the violent swings that you're seeing and all of the huge volumes you're seeing has still been a function of credit and concerns about credit. And as those concerns dissipate, GE is going to start to trade much more normally, I believe.
John, Dennis Dick here. What would it take for you, like for GE to do, for you to turn around and get bullish the stock?
Well, GE is a long cycle company, right? And in that context, it means that its fortunes don't really meander with the economy. So in theory, one could become more positive on a name if you felt the economy was going to get better or you felt better about China or whatever. And that's really not the situation here. I guess I certainly have a lot of respect for Larry Culp. He doesn't necessarily have a background that's completely aligned with the workout task at hand. I think it's just going to take time, to be honest with you. And I'm not sure that there's anything Culp or anyone else necessarily can do in the short run that would actually say, look, all of a sudden what you thought was X is really something completely different. They're on record many times as saying this has been a real problem. It's going to take a very long time to work through, et cetera. So we're objective, we're going to keep an open mind. I suppose if there was some sort of mechanism to restart the M&A process again to change the base of businesses, to make those look a little more attractive, but I don't think that's going to happen for a very long time. I think you just have to be patient. GE is going to need a couple of years to work through its very difficult financial situation and its negative cash flows. We're not going to wait till the very end, but I think it's important to at least see what they are saying with respect to the moving parts. You got to remember these moves in the stock, right, which look mesmerizing on a percentage basis. You're only talking $1 or $2 off a very low number. These moves in the stock have happened without any kind of a look forward or concrete guidance from the company. Culp's been there now several months, and they haven't said anything about what cash is. In fact, they've deliberately not said anything about what cash is supposed to look like this year, other than offering little snippets. They haven't talked about the segments. They haven't talked about guidance. As I said, they earned 65 cents. What are they going to earn in 2019? 35 cents? 40 cents? I mean, nobody really knows. So why is the stock moving so high or so fast? In part, I think it's because of the impact of passive investment and the impact of momentum and really just the normalization of what had been perceived as a liquidity crisis. When the dust settles, we'll see where that's at, and then we'll probably take stock of how to think of it going forward. But I don't think there's anything he can do in the very short run that would change our opinion. I think it's more of a matter of time and letting this settle and coming up with a framework that we can then start to analyze, because we really haven't had a framework put out by the company. We've just, everyone's been taking shots at this based on public disclosure and doing diligence on the side. And, that gets you so far. And so far it's been the kind of correct call, at least on the trend line. We'll see if there's anything beyond that.
John, before we let you go, I want to get your quick thoughts here on Honeywell, another stock in your coverage. Since we last had you on, they came out with their earnings report, pretty good on the headline, and then their guidance was above expectations for the EPS and sales in the Q1. So thoughts here on Honeywell?
Honeywell last year spun a couple of businesses. One was a turbocharger business, and one was a homes business called Residio, and the turbocharger business was called Garrett. Working through that, there's a lot of sort of moving parts with respect to kind of overhead costs and where those costs align and so forth. And so one of the things that had happened was analysts and the company itself took a very conservative approach last year toward its 2019 guidance. And so the good news is, with the economy still pretty resilient, particularly in the US, Honeywell in a lot of positions globally, say in China and other places that are not directly being impacted by economic softening today, it does appear that there's a runway ahead of them to be able to continue to put up some very good numbers, some very strong results, and beat expectations. The other aspect of the Honeywell story is very strong cash flow. So they've had a new CEO just over a year, and I'm gonna maybe call it just over a year. That's right. And he's a real tiger. He's been upturning every possible rock at Honeywell to see how they can actually rekindle core growth at this company. So if you look today at Honeywell, about 60% of the company is growing at a mid-single digit type of basis, but the other 40% is not. It's part of their legacy. It's important. You can't just sell it. But if you can actually come up with a framework to try and work through those businesses, maybe change their functional model and get better core growth coming out of this, you could actually be talking about some very nice numbers, even beyond what we think is going to be realized today. Now, Honeywell also has been riding a very strong aerospace cycle. That's not likely to continue. So I just caution everyone. I mean, they put up 10% core growth in aerospace last quarter. That's going to soften. That'll soften, probably toward the trajectory of, revenue passenger mile expansion. But, half of that business, or almost half that business, is military as well. And that's actually doing well just based on renewed Defense Department spending. So Honeywell, between the cash, the new CEO, driving internal improvement, there's always a chance of more M&A too, to reshape the portfolio. But no, I just think the numbers are still going up, and I think it's definitely a good stock to own, and I would buy it today.
All right, we've been on the line with John G. Inch, Senior Analyst for Multi-Industrials at Gordon Haskett. John, as always, thanks for the time, and we'll be in touch later in the year. Have a good one.
Of course. Have a good one, everyone. Take care. Right. Bye-bye.
8:53 here, Joel. Anything doing in the overall market?
Oh, no, we're very quiet. We're just hanging above, the high from last week at 28.14. That's also mid-range on the session. So actually, this is one of the very, very quiet session, not giving back any gains, and important to go out and take out that pre-market high which stands at 1975.
And balances here, a few notable ones. Pfizer, 163,000 a sell. That's significant. Stocks trading up 7 cents, but that holds. It's probably going to open down. I do see Square. Square had a really rough day on Friday, and that continues here this morning, at least from an imbalance perspective. It's trading up here right now, but another 45,000 to sell. And you just wonder if that's going to open down here too. I know it's trading up here at 30 cents right now. Just keep an eye on that. If that sell imbalance grows, Square could open down again. It caught a few people on Friday where the stock opened down and it continued to go down. And sometimes, just because it has a big sell balance doesn't necessarily mean you want to be a buyer into that. Sometimes those sellers continue to show up in the regular session as well. And obviously anybody who bought that open got hurt pretty bad because Square at one point in time was down over $3. So just keep in mind, I know I just said that there and it starts getting hit here, but it's now 76,000 to sell. So the sell imbalance is actually growing here, and 77 to 76. When I just said it a second ago, now it's back down to flat, 77.47. So some people excited there. That's got a sell imbalance.
All right. I want to get to, before we wrap, Dennis, right before we started the show, you mentioned some stocks that had some real big magnet type levels, and we've discussed Tesla and 300 ad nauseum here, but there are a few others that you highlighted, and I wanted to kind of run through those before we wrapped up today. So you had mentioned like Visa. And
just big levels we're coming into. I mean, stocks that have not been up to these levels ever, and Visa's just that's just a big psychological level. So we always talk about the buck, and I talk about it a lot. But when you start coming into stocks that are starting to make new all-time highs, you start to run into institutional sellers that are willing to sell. And Visa's got 150. I can see it in the books. There's 130,000 shares to sell in Visa. So anybody who's buying Visa above 150 in the pre-market this morning probably don't have the book or probably don't subscribe to it, because there's very little chance that Visa is going to open over 150. Can it take it out in the regular session? Absolutely. Can it take it out during the pre-market? Yeah, but is it going to open over 150? Probably not. Thing was trading up at 150 and a quarter this morning, 130,000 for sale in the New York book. That liquidity becomes active at 9:30. So what that means is it takes 130,000 shares of buying pressure to take at the open to take out 150. It's only traded 18,000 this morning. So unless it comes out with news in the next half an hour, it's very little chance that Visa is going to open over 150. So it's just an edge. I mean, anytime you see this thing trading in pre-market, 150.10, 150.20, I was actually trying to get short it this morning there, but I got sidetracked and I didn't put a trade on it. But those are little edges there. So, and if you look, there's just a lot of other stocks that come in at big levels. Johnson & Johnson, $140. It's come all the way back, when we had all those concerns over the talcum powder. Well, just, it's just quietly crawled its way all the way back. So you start thinking, you get to 140, it's a big psychological level. I haven't looked at the book, but I'll look right now, and I'm just willing to bet there's probably something there. Yeah, 138,000 shares for sale at 140. So you need to be respectful of these big levels, because that's where institutional sellers put their orders out a lot of times, and sometimes they just show up in the book. So Johnson & Johnson, huge level. Coke has been struggling at 45.64, and you can say the last couple of days, look at this, highs 45.61, 45.64. And, it's a funny level. Sometimes they're not obvious ones, but when you got the book, you can just go look. And if I go look at the KO book, I can see at 45.65, somebody's selling 400,000 shares. So it takes a lot of money to push it through that. So the only reason it topped out at 45.64 is because you got a big seller trading at 45.65, and there wasn't the buying pressure to push it through that. So you got to know that. So you keep that in mind. If you look in the pre-market, lots of sellers line up 45, 57, 58, 60, 62. They aren't doing that randomly. They're looking at the book and saying, I don't think it's got enough buying pressure to take it out. Takes out 65, the 400,000 shares. Then it's got room to 45.95, where I don't know if it's the same seller, but they're selling another 400,000 shares. Pretty coincidental if you have two sellers selling 400,000 shares 30 cents apart. So, and then if you look another 20 cents up, you have another 400,000 shares. So this is an institution that is just, just throwing out, chunks of 400,000 shares up, 10, 20 cents from where it closed, up another 30 cents, up another 20 cents. They got a big piece. So they just throw it out in big pieces there. So I'd imagine that's the same seller. And this is information readily available to you in the book. We're not giving you inside information or anything like that. It's right there. If you subscribe to the open book, you can see this information, and that helps you if you're a day trader.
All right, one more thing I wanted to get to before we wrap today, and that is a stock I don't think we've discussed in like 3 years on this show, and that is Office Depot. But they have news this morning. Office Depot, ticker ODP, has partnered with Alibaba to, among other things, empower their e-commerce sales and empower small business lending, small business sales online. They're going to create their own separate section on Alibaba.com for Office Depot merch, and it's just a general synergy partnership between the two. Office Depot.
Apparently good for Office Depot. It's trading up here in the pre-market, but am I going to get excited and go pay up 10% for Office Depot? because they got a partnership with Baba? Nah, probably not. So $4 is going to be a psychological level. Let me go look at the book in this one too. Joel, you can do your technical thought.
Yeah, I mean, you stuck your head over $4. 408 was the initial high, and now people have gathered up at $4. I guess with this one, you just want to see if, the big day traders, the big money comes into this one, goes forward bid. I'm not sure what the short interest in this one, but for me, for this to be for real, seeing up a stick on the day, open up 390, 395, get over 4, hold 4. Not much to look at in the as far as the dailies go. You have to look at the monthlies. You had a monthly high in October of 2017 at 465. So that's another potential target. And I think that was when they were doing the staples on, staples off deal. So that's another level, but important for OTP to clear $4 here.
Yeah, that's just huge. It's a NASDAQ stock. I didn't realize that. When you get I think it used to be New York. And you get those 3 symbols, you automatically assume it's going to be New York. But they used to be simple. Back in Joel and my day, back in the 90s, if I had 3 symbols, it was on New York. If I had 4 symbols, it was on NASDAQ. Remember when they had it simple like that?
Yeah.
That doesn't apply anymore. Life used to be simpler, Joel. It used to be simpler.
All right, Spencer, you want to wrap things up here for Monday, March 4th, a cold day here in the Motor City.
Looking ahead to tomorrow's show when we'll be joined by Gil Morales, author of the Gilmo Report and managing director at Mocha Investors. He'll be on tomorrow at 8:35. But if you missed any part of today's show, or you want to catch that again, or any part of any previous show ever, you can catch the full archive of our podcast. We're on iTunes, SoundCloud, Stitcher, TuneIn, Google Play, and pretty much anywhere you get your podcasts, or just go to youtube.com/Benzinga TV. Thanks to our guest, John G. Inge. Thanks to all of you in our chats. Please remember, all the information from our show is for informational purposes only and not meant to be investing advice. Hope everyone had a good weekend.
Before you let it go, bonus stock time, because it is moving right now. And Spinner's saying EA up to 50 million players. EA is getting a lift. Bring up the pre-market chart. I'm assuming Apex. This just happened because this is starting to lift here right now on EA. 101.60. Again, we already have precedents here. So the last time this swing went up to 35 million, the rally got sold. I don't see any reason why this rally doesn't get sold again. So I think you're getting a 4-point gift here this morning.
Oh, man.
And maybe it continues. So let the dust settle. Maybe they announce it on CNBC. It gets even more of a pop. But I think when we look at this, I think this is going to be a fade. My opinion.
Potential target 102.91. That was your February 20th high in EA, getting a nice lift.
I'm trying to find when they came out, when they announced they had 25 million. What day was that? That was, oh gosh, I don't remember. It was a few weeks ago they announced they had 25 million. So I guess they doubled their. Man, that's impressive. All right, that'll be it for today.
I'll be looking to fade this today at the open.
All right,
in my opinion.
All right, good luck to you, Dennis, on that fade. Good luck to everyone else here, and we'll see you on Tuesday.